Hi everyone, Zach Anderson of Valley Estate and Elder Law. I'm here today to talk to you about life insurance as an estate planning tool. And this has really changed over the years with regard to the estate tax structure that we'll talk about in just a second. But there's two main ways that we use life insurance policies as an estate planning tool. And the first way is to use beneficiary designations to encapsulate a trust into an estate plan with regard to a life insurance policy. And what that means is if you have a life insurance policy and that's going to pay out when you die, let's say it's a term policy, so we're not planning on using it. Maybe you have small children and you're only 40 years old and you're relatively healthy. We don't plan on using that. This can work for whole life as well, but think about an example with term. If you have a $2 million life insurance policy on your life, maybe your spouse is your primary beneficiary, maybe your children are your contingent beneficiary. Well, think about it. If your kids are 9 and 4, do you want them getting a check for the proceeds? Most people don't, and it's not a good idea. So what a life insurance policy paired with smart estate planning can do is we can say, we'll make the contingent beneficiary of that life insurance policy a trust that I set up, whether it's a lifetime trust or it's a trust that's only created under your will. For example, we could have parameters about if I have a child that's under the age of 20 or 25, then this trust gets formed that they're the beneficiary of. So that's a really smart way we can pair life insurance and estate planning to ensure that your small children, or perhaps a child who's older but has a disability or something like that, instead of getting a check for the life insurance policy proceeds, which a child can't even do that. They'd be wrapped up in a court supervised conservatorship proceeding, which is still not what we want. But instead of that child or person who's incapable of getting a check for $500,000 or $5 million or whatever it is, they get the benefit of it in a trust. They're the beneficiary of a trust that you set up with your estate planning attorney. So that's the first way, by far the most common way I help my clients pair their existing life insurance policies with their estate plan to, again, let their beneficiaries, their spouse, their kids, nieces, nephews, churches, whomever, live the best life they can live. That's sort of the whole point of estate planning. Trusts and life insurance policies often intertwine to do just that. The other way that you can use life insurance policies as an estate planning tool is in the context of estate taxes. Now in Alabama, we have no state or local estate taxes. So we only have to worry about the federal estate tax. The federal estate tax exemption is currently $13.6 million per person. That means if you're worth less than this, you don't have to worry about federal estate taxes. And I wrote down here can double, because if you're married, you can double that number. So we're at $27.2 million for a married couple. None of my clients hit that threshold. So we don't have to worry about that in the state of Alabama, the state that I practice in, but I know I have viewers in other states, and some states have an estate tax and their exemption can be as low as $1 million. And that could include life insurance policy proceeds. So definitely something to think about in, I believe, roughly the 17 states that still have some form of an inheritance tax or a death tax or something like that. Alabama is not one of those 17-ish states that do that, but if you're in a state like that, this becomes much, much more important. What we see here are a couple things. One, we can kind of get that asset out of our gross estate, the life insurance policy, so we can actually reduce the amount that we're getting up to that number. So instead of 13.6, if 3.6 of that was a life insurance policy owned by like an irrevocable life insurance trust, wouldn't be something that we have to worry about, okay? The bigger thing we see here, and again, I don't really deal with this because the exemption's so high and Alabama doesn't have one, is liquidity to pay estate taxes. So if you have a lot of assets that are worth a lot of money, let's say $40 million, may not be $40 million in the bank. It might be $40 million worth of real estate, worth of farmland, worth of business interests, things that you can't just go on eBay and sell for cash, right? Well, life insurance can give us liquidity to pay estate taxes, and that's often used in a similar vein there. So beneficiary designations with a life insurance policy, making the life insurance policy, having a trust of some sort as the beneficiary of the life insurance policy. I do that all the time for my clients. Estate taxes, also a use for life insurance and estate planning. This is a much bigger deal in states like Oregon, Massachusetts, where the estate tax exemption for state purposes is much lower. In states like Alabama, this is not going to be impactful for well over 99% of families, and I believe 100% of my clients. But nonetheless, now you know how life insurance policies can work with estate taxes as well as with beneficiary designations.